Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. This is episode 114. We are here together, myself, Aaron Hoisington, and my cohort, Ryan Nelson, founder of Alchemy Wealth Management. Ryan, what's going on with you today, my man?
Not too much. Same old. What about you?
You know, another day, another dollar, hopefully. At least a couple of them coming in there. So, but no, good day. Good, I'm excited to be here. I hope everybody is to be tuning in for this podcast. Hopefully you're listening right when this drops on every Tuesday morning. Hopefully it's one of your favorite podcasts that you guys check out as well. And Ryan, let's dive into today's topic. You ready?
Let's do it.
Cool. So we're going to talk about, we're going to throw in some acronyms because that's always fun with these podcasts here. But I think the overall topic is pretty important about like knowing what, who insures your money. The terms like FDIC, NCUA, like all these terms kind of get thrown out there about like, what are they specifically? And we did an episode, I think it was episode 90 back. We got a listener question about where to keep your money and how to choose your bank and all these different things. So I'm curious about this topic to what is covered by these terms FDIC, NCUA, and what they actually mean, I suppose. So, and maybe what they don't mean as well, because sometimes I think that's almost as important. So I'm hoping you can kind of break that down for the listeners here, and I'll go ahead and pause and let you take it away.
Cool. So yeah, most people when they talk about their money in the bank, they assume or infer that it's secure, right? Mm-hmm. And when people talk about their money being safe in the bank, usually what they're effectively alluding to is that it's a federal deposit that is insured. So there's really kind of two players there. It's FDIC, which is for banks, and NCUA, which is for credit unions. So FDIC, we'll start there. It stands for Federal Deposit Insurance Corporation. So FDIC is an acronym, obviously. Again, Federal Deposit Insurance Corporation. And that insures deposited accounts at FDIC-insured banks. So if the bank was to fail, if I had $200,000 in an FDIC-insured bank, that bank fails, basically this insurance will step in and give me my $200,000 back, make me whole. And another thing is, so it's insurance. It's not something you have to buy. So your money being there qualifies you for having it. So that's an important detail. It's not that you have to go buy FDIC insurance. Right. By having your $200,000 at that bank who is FDIC insured, that you're good. That covers you. You don't have to buy a different product on your own.
Good to know. Yeah, that's a big piece of it. Because you think insurance, you think something else you like add on top. But that kind of seems like it comes with having your money in that bank.
Yeah. So then NCUA, that stands for National Credit Union Administration. And so it's very, very similar, but it insures credit unions. So these shared accounts at federally insured credit unions. So both FDIC and NCUA, it will typically insure up to $250,000 per depositor or member of your credit union at these insured places. Per ownership category, which is an important variable that we'll talk about a little bit later. But so what that means is it's not $250,000 per account. So I can't go open a Wells Fargo account in my name, put $250,000 into it, go to a different Wells Fargo branch, open another account in my name, and put $250,000 into it. That would still be that would then therefore be $500,000 in like an account in Ryan's name.
Sure.
In Wells Fargo. So you want to be careful about how it's titled. And so if those two accounts were titled the same way, it would be $500,000 at the same bank. So basically what is covered FDIC is going to cover like checking accounts, savings accounts, CDs, and some money market accounts that are at these FDIC insured banks. NCUA, that's going to cover effectively the same thing, right? Shared savings accounts, which is what credit unions call these, checking style accounts, and deposit accounts. So effectively, the credit unions have some nuanced differences in their naming nomenclature, but effectively it's going to be covering the same kind of style of accounts at both the kind of a more traditional bank and then the NCUA for credit unions. So what is not covered? This does not cover your stocks, your bonds, your mutual funds, your ETFs, your annuities, your life insurance, your Bitcoin or other cryptocurrencies. It also doesn't cover like your contents in a safety security box. Okay. So you can't go put a thing of gold in your safety deposit box and think it's FDIC insured, or buy a stock from, a Wells Fargo and think it's FDIC insured. That's just not the case. So again, it was covering the checking accounts, savings accounts, CDs, stuff like that. That same concept is going to be true for the NCUA as well. So you can see that these are very, very similar.
They're quite similar. A lot of overlap for sure.
Yeah, exactly. Let's talk a little bit about those ownership categories. So I gave that example before. If I put $250,000 in one branch office of Wells Fargo, and I go into another branch office of Wells Fargo and put another $250,000, I just now have $5,000 in Ryan Nelson's name, right? What's interesting is you can have more than $250,000 at one bank and have it be insured. It just has to have a different ownership category. So I could have one in, say, just my account, my name, Ryan, and then I could open an account with you and have one in Ryan and Aaron's name, and open an account with my fiance and have Ryan and Katie's, right? And those would all now have different ownership categories and have their own limits. So I could go put $200,000 in all three of these different accounts, and now I would have $600,000 at one bank, all FDIC insured, right?
Okay.
Or you could spread this out. So again, we mentioned CDs are insured. So sometimes when we have a client, if they come to us and they need, for whatever reason, $1 or $2 million in CDs, it wouldn't be very responsible for us to take $1 million and buy a bunch of Wells Fargo CDs, or $2 million and buy a bunch of Wells Fargo CDs. We'd want to spread that out and put some money at Wells Fargo, some money at Bank of America, right? And so we could buy them these different CDs at these different banks. And then, let's say we put $200,000 in 5 or 10 different banks. Now they have $1 or $2 million, all FDIC insured, right? So it's possible to have more than $250,000 of FDIC insurance, just not at the same institution with the same title.
Right. Okay. Gotcha. Yeah, that makes that interesting. Yeah, there's ways around it, if you will, or I don't know if it's around it, but ways to maximize it if you have an X amount of money that you want to put that's above that $250,000.
Yep. Cool. So clearly, there's a lot of similarities here between FDIC and NCUA, right? They're both basically federal deposit insurance. They have a very similar structure. It's $250,000 per person, per institution, per ownership category. So lots of similarities, right? The differences are FDIC insurance covers banks, NCUA covers credit unions, and a little bit of the the jargon, right? Technically, FDIC insurance, because it's for banks, is covering deposits, whereas credit unions, oftentimes what they call it, shares.
Okay.
So, but you can see those differences aren't very stark. You might be wondering, cool, how do I tell if this is insured? So you'd want to go, the best way would probably be to ask the financial institution, but typically they'll have like an FDIC or NCUA sticker in there,
right?
Like the door when you open it to go in.
Yeah. Or you hear it on like the commercial. It's almost always like plastered somewhere. The financial institution has those.
Yep. And one thing to be aware of is some like cash accounts are actually brokerage accounts. So they're investment accounts that are using third parties. And so the insurance is going to depend on where that money is sitting, right? So it is possible for some people to have some like sort of cash in an account that they think is FDIC insured that's actually not. So it'd be something to just be aware of and pay attention to. So common mistakes, right? People having kind of that example I gave earlier, having multiple accounts at the same bank. So if you have 4 accounts in Ryan Nelson's name, all with $250,000 in it, those aren't all FDIC insured. Only one would be FDIC insured. So you'd have to change the ownership category if you want them all at the same bank. There can be some confusion with money market or mutual funds. So just make sure that if you're investing in something at the bank, make sure you have an understanding. You can just ask them, is this FDIC insured, right? Likely the money market is, and likely the mutual fund isn't, but just get that confirmation. Often again, I hear, not often, but more than once, somebody thinking that their safety deposit box is insured. So that's something you'd probably want to be aware of. And it may be secure, but not necessarily have FDIC insurance.
Sure.
So if you have 20 grand and sitting in a safety deposit box, that may not be FDIC insured.
Okay.
And then let's see. Yeah. So really, I mean, there's some ways around this, like you said, making sure you have, there's ways to, even with big dollar amounts, there's ways to make sure it's all insured. Right. Just spreading it through different financial institutions or changing the ownership category. And in no way is that unethical or shady or anything.
Right. That's what I was going to ask, because like a lot of times when you're like, oh, to kind of get around this, that's kind of has a negative connotation, but it seems like that's just, it's kind of encouraged, like if you will, like for
exactly.
These things.
Yeah. In a while back, gosh, I don't even remember now. There was the banks in San Francisco that failed. I can't think of the name of it, and I want to say it was like 2 years ago now. I could have my timeline off as well. But this was a big topic in the news, and there were people who had more than $250,000 in their bank accounts, and FDIC actually insured all of them for the entire amount. So they only had to step up and give, if somebody had $5 million in this bank, FDIC was only basically on the hook to give them, if they had $500,000 in the bank, FDIC only had to step up and give them $250,000.
Right.
In that situation, they made everybody whole. And to my recollection, I believe I heard something at that time, this would be worth confirming, that FDIC, that basically every bank failure ever, everybody's always been made whole.
I thought I saw that too.
Yeah.
I'd have to confirm, because it was like Silicon Valley Bank or something like that.
I think that was it.
That was the one that, but yeah, I think there was something that they were preaching that like, it's all, there's never been like an instance where people weren't made whole or a bank wasn't made whole. I can't remember the specifics of it, but I do remember, I think it was 2023, I want to say, when that kind of happened there. But yeah, I remember they were just like, oh, this happened, like we're going to make everybody, and it was kind of an interesting thing. It was like all the rage in the news for a minute, and then it's just like gone. And I was like, okay.
and I just did a quick Google just to make sure I wasn't completely wrong. So it says, since the creation of the FDIC in 1933, no depositor has ever lost a penny of their FDIC insured funds. Up to the standard insurance limit. So, however, for depositors that exceed the insurance limit, $250,000 per depositor, per bank, per ownership category that we talked about, right? It's possible for a depositor to not be fully made whole unless a special exception is invoked by the government.
Okay.
And I want to say that that has always happened, but either way, it wouldn't be. I've heard some people get a little nonchalant and say, oh yeah, I have $400,000 in this account, but technically it's only $250,000 is covered, but that's they would still make me whole. It's like, well, probably, but
you could just take a risk there.
You could just move $150,000 to a different bank and know you're good.
Exactly. Yeah, just be able to sleep a little more soundly.
Exactly. But yeah, hopefully that gives a little bit more clarity to these insurance types.
Absolutely. No, I think it definitely does there, my man, for sure. I think that that's a good way of painting that picture and thinking about, like, if you have that situation where you potentially have $250,000 or more to put in, like it's one of those problems. I'm like, that'd be a good problem to have. Like, how do I make sure all my money's insured? that'd be oh man, I'm hitting the limit at this bank. Awesome. Like, how do we get into a different one or a different account or something too? So ways around it for sure. And it could set you up pretty nicely as well. So awesome, Ryan. We'll appreciate it. We'll go ahead and pause here real quickly and be back on the other side of this. Everybody hang tight.
And now, to put the personal in personal finance,
Welcome back, everybody, to this side of the Fiscal Physical podcast. We are still here, Aaron and Ryan, and we're going to do a little trivia question for you guys. Haven't done one of these in a minute.
Let's do it.
Ryan, I'm excited to see if you continue to wow me.
Yeah, my luck's come to an end, I'm sure.
Also, my bar is relatively low, so
good.
you never know. So we'll see how it goes. But all right, so we're going to do, it's a two-part question, kind of a similar thing. First one is, I think you'll do pretty well on this one, but what are the 5 largest states in the United States by area? So by square miles, if you will, or just the largest ones that are out there, top 5.
Alaska, Texas, California.
Yep. Those are the top 3 right there. Bang. 2 more. These are where it always gets interesting. I always think about the shape of a map, and I'm like, what takes up most of the space on those?
I know. God.
I'll give you. They are on they're west of the Mississippi River.
Oh, okay.
If that helps.
A little bit.
Yeah.
The only one that was east that I was considering was Florida, but I wasn't really sure how big that was.
Yeah.
Okay. Well then, God. Nevada could be up there. I think it's between Wyoming, Nevada, and Montana. My guess would be it's 2 of those are the, or 3. 2 of those 3 are the remaining ones. I'll say Nevada and Wyoming.
Okay, so incorrect. Montana is number 4.
Oh, okay.
So you were right there with it. And this one actually got me because I was like, wait a minute. It's New Mexico. Is number 5. It has a ton of land out there.
Good
and
for them.
I'm like, oh, sweet. But it's pretty close. Nevada's 7th, I believe. So it's right there. It's Nevada and Colorado, and these different ones are really close. So,
cool.
So pretty good. 3 out of 5, not bad. Nailed the top 3, and you had the 4th one there. Just didn't go with Montana.
Sure.
Now we're going to pivot on what are the most populated states in the United States. So the ones that have the most people who live in those states.
Yeah. Nevada,
Rhode Island,
most populated
states there. There are some overlap.
So Texas, Florida, and California are the top 3.
Top 3, yeah. Excellent.
God, it could be New York. Let me think.
Because it's all since because you think about. I'll give you a hint. It's not Montana.
Yeah.
These different ones that you're like, oh wow, it's got a lot of space going there, but not a lot of people actually live in Alaska.
Right. Yeah. God, New York's so small, but it's so dense. I'm gonna say New York.
Okay, that is number 4.
Okay, and then oh God, it's. Is it another in the northeast?
Yes, yeah. It's. I'll say it's east of the Mississippi.
Yeah. Let's see.
But it's in a similar kind of area up there, which I honestly always
Is it
forget.
Pennsylvania?
It is. Yeah, dude. Nice, excellent job. That's what I always forget about that one. As far as but you think Philadelphia is huge. You got Pittsburgh on the other side. You got Harrisburg, which is the capital. It's got 3 or 4 big cities in there as well too. So I was always I always think about when they do the every 4 years the electoral college the election of this one has 3 votes, and then it's this one has 60. And you're
exactly.
Oh, okay. That's clearly got a lot more people in it there. So pretty good, man. You got 8 out of 10.
Hey,
so 80%.
80%.
Yeah, not bad at all. So I'm curious if the listeners out there, I want someone to text me and say, hey, I got all 10 out of those, and I know exactly what's going on with them. But I think that a state trivia that's always kind of fun because you're like, huh, how big is this state in comparison to population is always really unique to me.
Somebody out there will know them all.
Oh, I'm sure somebody will out there. Hopefully one of our really smart friends will know it. So, awesome. Well, appreciate it, Ryan. As always, we'll go ahead and wrap this one up. But before we depart, I'll leave you with the final words.
As always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your fiscal physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.